Before we dive into charts, data, or price targets, I need to ask you something directly. How are you holding up? And I mean that with complete sincerity, not as some scripted opener. This silver move from $65 to $86 has been nothing short of violent. The whipsaws have been brutal. The emotional toll on anyone holding positions through this has been real. Some of you are up significantly. Some of you bought higher and are still underwater. Some of you sold at $70 thinking it was over, and now you are watching from the sidelines with regret eating at you. Drop a comment, just 3 words, BullionBeyond. That is it. It tells me you are here. It tells me you are paying attention, and that is all I need to know. Because what I am about to show you is not hype. It is not speculation. It is the raw structural picture that most people will not see until it is already too late. I spent hours going through every comment on the last video, every single one, and what stood out was not the price predictions or the panic. It was people genuinely trying to understand the mechanics underneath this move. That is rare. That tells me this community is different. And if you are one of those people who showed up here with a real desire to learn, not just to get rich quick, this channel is going to become extremely valuable for you in the months ahead. Now let us get into what actually happened in silver and why 100 is not some random number being thrown around for clicks. It is a mathematically probable outcome based on the structure we are seeing right now. Silver closed the week at $86 spot. That is a 32% move from the $65 low we saw just weeks ago. Let that sit for a moment. A 32% move in a commodity market that is supposed to be stable, liquid, and efficient. Now ask yourself, what kind of underlying structural imbalance produces that kind of price action in such a compressed time frame? The answer is not mysterious. It is documented. It is visible in the data. And the ones who are actually pulling the numbers instead of reading headlines already know exactly what is driving this. Let me start with the physical supply situation because this is where the entire thesis begins. The COMEX registered silver inventory, the metal that is officially available for delivery against futures contracts, has been sitting below 90 million ounces for weeks. Meanwhile, open interest in the March contract alone represents over 200 million ounces of theoretical delivery obligations. That is more than double the amount of silver that is actually registered and available. Now, conventional market structure says that is fine, because most contracts roll forward or cash settle. But here is what makes this time structurally different. The roll pace has been dangerously slow. Traders are not rolling, they are standing for delivery. And when delivery demand exceeds available registered inventory, the price mechanism has to absorb that imbalance. That is not theory. That is how commodity markets function at the most basic level. Simultaneously, eligible silver, the broader category sitting in vaults but not immediately deliverable, has been draining at a rate that suggests physical offtake is accelerating. Over 15 million ounces left eligible inventory in the span of 10 trading days. That metal is not disappearing into thin air. It is being pulled out of the exchange system entirely, either moving to private storage or leaving the country altogether. And here is the connection most people are missing. China was offline for Lunar New Year. One of the largest physical silver demand centers on the planet was essentially dark for an entire week. Silver moved from $78 to $86 during that period, with China absent. Now they are back online. Shanghai Silver Exchange reopened this week, and the physical premium inside China is running $8 to $10 above Western spot prices. That is not a small arbitrage opportunity. That is a structural dislocation, signaling that physical metal is being bid higher in the world's largest manufacturing economy than it is trading in the paper futures market. When a recycling company in Shenzhen, one of China's primary precious metals hubs, is offering the equivalent of $95 per ounce to buy back pure silver, while Western futures are trading at $86, that tells you something critical about the physical bid underneath this market. Chinese industrials are not offering premiums like that because they want to. They are offering them because they have to. Because the supply they need to keep manufacturing operations running is not available at current spot prices. And when industrial demand starts competing with investment demand in a market that is already running a structural deficit, the price does not move in small increments. It gaps. Now let me give you the supply side of this equation because this is where the math becomes unavoidable. Global silver mine production is approximately 830 million ounces annually. The Silver Institute has confirmed we are now in the 7th consecutive year of running a structural deficit. Demand is outpacing supply by nearly 200 million ounces per year. That is almost 25% of total annual production being consumed from above ground inventories every single year. And those inventories are not infinite. They are measurable, they are tracked, and they are shrinking. The question is not whether this imbalance resolves. The question is when and at what price level does the reset occur. Here is what makes the current move from 65 to 86 structurally significant beyond just the percentage gain. Silver dropped from $121 all the way down to $65, and it still closed green on the month. Let me repeat that because it is important. They crashed silver 46% from its peak, and the monthly candle was still green. That tells you the physical demand underneath this market is strong enough to absorb forced liquidations, margin calls, and an entire Chinese fund being put into liquidation-only mode. The structure held. Most people's conviction did not. And that is exactly the dynamic that separates long-term wealth builders from short-term speculators who get shaken out at every inflection point. Now connect this to what happened during the $65 to $70 range. Almost every voice in the precious metal space flipped bearish. Sentiment capitulated. YouTube videos titled Crash and Collapse started flooding the algorithm. And I told you then we had a structural support zone between $65 and $68. I told you to watch for a bullish swing failure pattern. I told you an inverse head and shoulder structure was forming on the daily chart. Nobody wanted to hear that when the price was falling. But the ones who marked those levels, who understood what the structure was saying versus what the headlines were screaming, they positioned accordingly. They did not need me or anyone else to hold their hand through the move back up. They read the tape. They trusted the structure. And now silver is at $86. That is not luck. That is what happens when you learn to separate signal from noise. And before anyone gets ahead of themselves thinking this is me calling a straight shot to $100 with no pullbacks, that is not the point. The point is understanding what the structure is telling you at critical moments and having the conviction to act on it when everyone else is running the other direction. Robert Shiller wrote extensively in Irrational Exuberance about how markets reprice risk before the broader public recognizes the shift has already occurred. We are watching that repricing happen in real time. Silver is moving from a suppressed commodity market into a geopolitical strategic asset, and the crowd is still trying to trade it like it is 2019. Here's the honest countercase because intellectual rigor demands it. A stronger dollar creates mechanical headwinds for dollar-priced commodities. Silver's 32% move in a compressed time frame has created a pocket of short-term traders sitting on significant gains who will look for any excuse to take profit. The $88 to $90 zone represents a prior resistance level that could act as a technical ceiling in the near term. And some of the supply deficit projections are institutional forecasts, not realized outcomes yet. Supply responses can alter trajectory if price incentives bring new production online faster than expected. These are real variables. Anyone managing actual capital has to account for them. But here is what the data shows that the forecasts do not fully capture. The London Bullion Market Association, the hub of global silver lending, effectively ran out of available above-ground stock earlier this year. Lease rates spiked when the interdealer lending network inside the LBMA seized and banks had to go public to borrow silver. That is not a projection. That is a documented market event. When the interdealer market stops leasing to itself and has to advertise publicly for metal, it means the informal cushion that has absorbed demand shocks for years is gone. Now, let me walk you through what $100 silver actually means in structural terms, not as a hype target, but as a mathematical probability based on current trajectory. If silver maintains its current momentum and physical premiums in Asia continue running art to $10 above Western spot, the arbitrage pressure alone creates a mechanical bid that pulls futures higher. Add to that the COMEX delivery pressure from March, contracts that have not rolled, and you have a supply squeeze forming in the paper market at the exact moment physical demand is accelerating. Howard Marks wrote in Mastering the Market Cycle that cycles are not driven by fundamentals alone. They are driven by what happens when the credit and liquidity structures built around an asset finally have to face physical reality. The LBMA lease rate explosion was that moment for silver. The COMEX inventory drain is the continuation of that same dynamic. Here's what most people do not understand about how commodity markets actually break. It does not happen slowly. It does not give you weeks of warning. It happens when a critical mass of market participants simultaneously realizes that the paper price and the physical availability have diverged beyond reconciliation. And at that moment, the price does not inch higher. It gaps. We saw a preview of that dynamic when silver moved from 78 to 86 in a matter of days. That was not driven by retail FOMO. That was driven by entities that need physical metal for industrial purposes, realizing they cannot source it at current prices. And when industrial buyers start competing with investment buyers in a market already running a 200 million ounce annual deficit, the price discovery mechanism has to reset violently. Now let me address something directly, because the comments from recent videos have made it clear this community is ready for deeper education. Someone wrote that fundamentals do not matter, only price action matters. They're not entirely wrong if you are a pure day trader. But here is what separates long-term wealth accumulation from short-term speculation. Fundamentals tell you what, technicals tell you when. When those two things align simultaneously, when the structural supply deficit thesis meets a specific price structure at the right moment, the conviction becomes unshakable. Nobody can talk you out of a position you understand completely from both angles. That level of clarity takes time to build, but with genuine desire to learn, 6 to 12 months is enough to get there. I have watched people who showed up knowing almost nothing about markets develop the ability to read price structure, pull primary data, and arrive at independent conclusions that proved accurate. Not because they are geniuses, because they were willing to do the work. Here is what this means for $100 silver. The path is not a straight line. There will be violent shakeouts designed to test conviction. There will be days where silver drops $5 in a session and every headline screams crash. And most people will sell at exactly those moments because they do not understand the difference between a structural correction inside a bull market and an actual trend reversal. The ones who understand the supply deficit math, who have marked the technical support zones, who know what a bullish retest looks like, they will add at those levels. That is the edge. Not predicting the exact top or bottom, but understanding the structure well enough to position intelligently when opportunity presents itself. Jim Rogers documented in Hot Commodities how every major commodity bull market experiences violent corrections that shake out the impatient even when the multi-year structural thesis remains completely intact. Silver dropping from $121 to $65 and still closing the month. Green is exactly that dynamic playing out in real time. The structure held, the physical demand held. What did not hold was sentiment, and that is by design. There's a reason sentiment behaves exactly the way it does at critical inflection points. A declassified 1974 U.S. State Department cable, not a conspiracy theory, but an official government document, explicitly described how a large gold futures market would make physical trading seem minuscule, amplify volatility, and discourage citizens from long-term holding. They understood the psychology 50 years ago. Flood the market with paper contracts, amplify the drawdowns. Let fear do the work for you. You do not need to force people to sell. You just need to create enough volatility that they sell themselves. When silver hit $65, sentiment did exactly what it was designed to do. The headlines screamed collapse. YouTube was filled with crash predictions, and almost everyone who did not understand the underlying structure sold into that fear. The ones who understood that physical demand was still running at deficit levels, who knew the COMEX registered inventory was dangerously low, who had marked the technical support zone, they did not sell. They accumulated. Now here is what to watch as we move toward $100. First, the COMEX March contract settlement. If delivery demand remains elevated and registered inventory does not see significant inflows, the squeeze thesis strengthens. Second, Shanghai premiums. If Chinese physical premiums stay above $8, that tells you industrial and investment demand in Asia is still outpacing available supply. Third, the technical structure at $90. That level represents prior resistance and a psychological round number. How silver behaves at $90 will tell you whether this move has legs to push through 100 or whether we see a deeper retest first. And fourth, managed money positioning in the futures market. Speculative long positions are still sitting near 20-year lows. When the momentum crowd eventually shows up to a market already running on extreme physical tightness, the move accelerates exponentially. Let me be very clear about what this channel is and what it is not. This is not financial advice. This is not a prediction service. This is education on how to read markets independently so that you do not need me or anyone else to tell what to do. My only goal is to make you sharp enough, precise enough, independent enough that you can walk into any market environment, pull the data, read the structure, and arrive at your own conclusion with complete conviction. Not followers, thinkers, people who do not need permission from a YouTuber to have conviction in their own analysis. That is what we are building here. And if you showed up with a genuine desire to learn, not just to get rich quick, you're going to look back 6 months from now and realize you understand markets at a level most people never reach. Here is the bottom line. Silver moved from $65 to $86 in a matter of weeks, while China was offline, while COMEX registered inventory sat dangerously low, while speculative positioning remained at 20-year lows. Now China is back online with physical premiums running $8 to $10 above spot. The March contract is heading into settlement with delivery demand that may exceed available inventory. And the supply deficit that has been running for 7 consecutive years is not resolving. It is compounding. Is $100 next? The structure says it is probable. The fundamentals support it. The technicals are setting up for it. But the path will not be clean. There will be shakeouts. There will be tests. And the ones who understand what they are holding and why they are holding it will be the ones still standing when the reset completes. Verify everything I just showed you. Pull the COMEX inventory reports. Check the Shanghai premium data. Look at the Silver Institute deficit numbers. The primary sources are there. Invest with logic, not hype. BullionBeyond out.